Good afternoon. My name is Don Vivrette. Welcome to the first of the episodes of It's Your Estate. Pete Kote is going to turn on his microphone and his camera. There you go. Just to prove that Pete is in fact here. Then I'm going to do a quick walkthrough in terms of PowerPoint, just to show you some ground rules and where all we're going and what's happening. And then we will come back and get going again. So hang on just a second.
It looks like, Don, that we're getting a lot of participants coming in. You want to wait maybe a minute or so?
Okay, we'll wait a minute or so. Pete, why don't you do an orientation?
Well, I want to wait it looks like the participants are coming in, like we got 120 and we've got close to 200 signed up. Let's
dance some more.
Put
the music back on.
Turn the music back on. I love that music. I really do.
Incidentally, for those of you who attended the session yesterday, the session went great. Really appreciate your input. One thing that we have learned is that Don needs to have on his clock 3 o'clock, because I stopped this a half hour early, and that was my mistake. So I have learned, and I have my note here that we go until 3. So we will be covering the other subjects as we go through the week. But if you were with us yesterday, as I'm sure many of you were, you know that Don made a mess. And so we lost a half hour of time, which gave you the time to go do something else.
Right. And the good news there too is that what we're going to do is we'll post the answers on the website so that if you want to go back through the quiz and see what the correct answers are, if you didn't get a chance to write them down because we went through them really, really fast. You'll have
and I will remember, incidentally, that we get to ask Pete tomorrow, what does FINRA mean? Because he said we'd answer that next week. I'm sorry, not tomorrow, next week. So
okay.
Anyway.
Maybe Marty knows.
Marty's being quiet. Marty's back. Oh, there he goes. Yeah.
I can Google it pretty quickly.
Okay. We're at 135, and it looks like people are
slowed down.
Yeah, it's slowing down. So why don't you go ahead and do your introduction, Don?
You okay, Marty? If Marty has the answer, I'll let him give it to us.
He doesn't have the answer yet.
Okay, I'm going to run up the PowerPoint, and we'll take a look at this and walk through it. So hang on just a second. So this is as we said, it's your estate from this standpoint, using the same slides that we used yesterday. You have registered. You got the confirmations yesterday for today and the next day as we go along. One thing I want to point out in here is the materials are the link that you have here, which is materials at itsyourmoneyandestate.org, is the same one that's in the reminders and all of those things. And incidentally, this is a nice thing for us. As of right now, the video from yesterday is already posted. So if you went there, the video is there. You can look at that and track through where we were. Again, as we did yesterday, we're going to use question and answers as the item to find out what's going on. Let me click on this guy. Which website ID did you post the answers? The same place you get the materials. So next week in week 2 of It's Your Money, we will post it there along with other material that comes in for that week. So that's what we will be doing with those. Next slide in here is, so this gives you where the link is. When you come into materials, right now it happened to be sitting on money. So you click on either money or estate as you go through. Right now, if you went to money, you would have the video as the first one listed. Next week, it will be week 2, and that's where the answers to the quizzes will be. So that's how you can take a look at those. This gives you an idea of a couple of things. Depending on the screen that you're on, if you're on a laptop, if you're whatever, there's this little bar between the slides that I'm showing and our picture. If you move that bar left or right, it increases the size of the slides, decreases our picture, whatever, your choice. And I know sometimes on tablets or iPads, you can scroll left to right and you can see where those are going. Also, question and answers. So we don't use chat for this. We use question and answers. You type in your question, hit enter, and I get it, like the one that I just got already. I will be going throughout this whole process when Pete and Marty are presenting. I will be reviewing those, and I will ask the questions as we go along. Where we will be going, let me come back over here. If you have two screens, I keep losing where my mouse is. Here's the schedule of where we are. So today we're doing a state the test that we, somewhat similar to what we did yesterday with money. And then we'll start into other subjects. You have these schedules. Each week when you get the reminder, it will give you the title of what the subject is for that week to see if you're interested in those. These are the locations we normally physically would be at. Obviously, we're not this time. We're completely virtual in terms of what we're doing. These are all the charities that are participating with us now and over time. I want to give a shout out to Chapman University for 10 years of sponsorship and supporting what we do and how we do these. So I want to thank them very much in terms of what's there. So that's all the piece that I have. So at this point, I'm going to pass this back to
Don.
Yes,
before you leave, talk a little bit about if the attendees today want to have other individuals participate, what would they do?
So the link that, the registration link that you have, that you had when you came into here originally, if you give them that, they can register themselves.
But they can't give them their personal link, right?
To be honest, I changed it so you can.
Oh, okay.
If you can't, Pete, because you have a different login.
Okay.
But because some of the people were saying, but husband and wife want to log in on different computers, I think because they're incompatible, we decided they didn't have to both register. So you can literally send them the link that you used to get in today, and our list, it just shows up, you're here twice, which is fine with us. So as many people as possible, we'd love to have them be a part of this. So yes, you can actually share your link. It's not the best course. I'd rather have them register, but you're welcome to just share the link that you got today, same as the one you got yesterday, and you will going forward. Otherwise, you can send the announcement page that you used to get here originally, send them that link and they can register themselves. Either one works, and it works just great.
Okay. All right. Thank you, Don. Are you going to disappear into the background, or
am I going to what?
And you're gonna get the questions? Okay, this is a whole new experience. First of all, thank you. We're looking at about 150 people participating. So, and this is our first time that we've done this webinar. Welcome. And many of you, hopefully, I think, have done some in-person and or visited, attended the It's Your Money program that we did yesterday. So some of you, this is going to be a repeat. So bear with me. Started this program approximately 25 years ago. And when I was at Long Beach State University, and we had very, very many smart people who had no clue about money and or whom was advising them on their money. A single time when I met with a faculty member or a person, I would walk away from that saying, but don't you care? It's your money. And that's how we got the title of the program. But my job at the Long Beach State University was to discuss planned giving, which means encouraging individuals who care about a charitable organization to leave money to that organization in some sort of a planned gift or estate plan, a will, charitable trust, etc. But how can you possibly even think about giving your money away unless you understand a little bit about money and you understand a little bit about estate planning? And where do you go to learn this stuff? Well, you know, if you have somebody die in your family and all of a sudden, you know, you're faced with the reality of what estate planning is about, or if somebody suffers from a stroke or Alzheimer's, or somebody is in the hospital, and you, as a healthcare agent, you need to make decisions for them. And then it hits home. And in my personal case, when my father died, we didn't have any of our documents in order. We were from Holland, so we were foreigners. And so we had no clue as to what we were doing. And what I found, though, is that very smart people don't either, because death, money are just difficult topics to discuss, you know. And the idea of how long do you want to be on a ventilator? You know, those are not easy questions. My mother finally told me, she says, if you bring up death one more time, I'm going to eliminate you from my inheritance. So I stopped talking to her about her death. But I enjoy talking about death because it makes me appreciate living more. And I hope you feel the same. We are essentially going to break down the estate planning area in about 8 different areas. And this being the introduction, and the quiz that we're going to take, or the test that we're going to take in a little bit, will just basically kind of highlight what most of the classes are going to be about. Lots of Q&As, so we encourage you to do so. None of the presenters are going to be charging us. We're sponsored totally by charitable organizations. And I want to say kudos to Chapman University as well for being a sponsor for the past 10 years. They pay us to put this program together. And the reason why they pay us, because we want to encourage you to make a gift to charity. We honestly believe that giving is good. And so no matter whether you want to give to one of our sponsoring charities or any charity or a cause, it's the one way that you can reflect your values meaningfully to your heirs. Because how do you else pass on values through a will? And as you can see, there are a lot of family issues when it comes to money and death. And so we want to avoid those. And every family has issues. So today, it's not about the taxes, and we're going to get through taxes in just a little bit, but it's about your family and what's best for them. Okay.
Pete.
Yes.
Pete, hang on. Since you said it was a good idea to have lots of questions, we have a lot of questions already.
Okay.
So there was one question in terms of, I don't see anything that says estate to be printed out. If you go to the website for the materials, to the left-hand side, there's a little space that says it's your money and it's your estate. I just checked it since we started, and there's a whole list of materials there for It's Your Estate, week 1. So I know the material's there. I was afraid maybe it hadn't gotten there. So that's where you go and find those, that material, and download it, print it, whatever you'd like to do with it. The other thing that came up, and it's an excellent one that I forgot to touch on, how do we get information on the sponsored charities or any literature? 2 things. Number 1, this week we didn't do it because it's the beginning session, but for the future weeks, we will have a 3 to 5 minute video on the various charities. So one week it's this, one week it's another, and you'll be able to see those as you go through. Also, I believe on our website, there is a charities section, so you can go there and get information on the charities. To be honest, I don't know that answer exactly. The last question that I have already is, are the links the same for this session and the rest of the series? Yes, for estate. It is different for money. So if we're now in estate, the link you use today will be the same link for all 8 weeks. It does not change. For money, it's a different link, but it's the same one for all 8 weeks. Those are my questions, Pete. Tag, you're it.
If we were live, the next thing we would do is to tell you where the bathrooms are located, either to the right or to the left, but we don't have to go through that on the virtual. And we will not be able to see you. And so It's a new experience. Marty.
Wait, one more before
Uh-oh.
Marty comes in. The question of what's the name of your website? If you go to the reminder that you got, there should be a note in there on how to download the materials, and that has the name of the website on it. Otherwise, it's a bit too long to read out to you right now.
Yeah, financialandestatelyiteracy.org or ityourmoneyandestate.org, either or.
There you go.
Okay.
I'm out.
We're going to go through taxes first because there's been so many changes and people don't understand taxes, especially when it comes to estate planning, and it's so important. So our guest presenter is Marty. Marty, can you show your mug and turn on your, there you are. You're outside enjoying the sunshine. Is your audio working?
It is.
Oh, good.
As long as you can hear me. You can hear me? Okay.
Yeah, I can hear you.
Great.
Okay.
Great.
Could you maybe show your bio or ask first form just to go through it real quickly to show who you are? And by the way, your ask first form is on our website on the materials page. Can you bring that up?
Yes, I can, Pete. Give me a second here. Okay. So since the Ask First form's on the website, I figured I'd bring this up. You're going to see some overlap in the information.
Good. You're a CPA, PFS, CFP. Do you do tax returns, or are you a financial advisor?
I'm a financial advisor. I've prepared tax returns in past jobs, but my firm does not offer that as a service today.
Okay. So you were with Deloitte Haskins and before, and then you were with Northern Trust for a while. And today you are in your own firm. How long have you been in your firm? How much money do you have under management? And talk a little bit about that.
Okay. Yeah. Today we manage about $100 million in assets for 60 families. We started the firm in 2012. I say we because I co-founded the firm with a business partner, Patrick Chu. And yeah, we're a fee-only firm.
And thank God you got a golden retriever.
That's an important one.
Yes, absolutely. Absolutely. Okay. What we're going to do today is that if you want to get Marty's phone number, address, and all that, it would be on the Ask First form. But what I want Marty to do today is do a tax update. What are some of the relevant information that we need to know about taxes when we're thinking about our money and our estate plan?
Okay, thanks, Pete. So wanted to talk about taxes in 3 areas today. And the first 2, I just want to spend a few minutes on, not a lot of time. I think they're really important to understand, but for today's presentation, we wanted to focus on the 3rd bullet point, income taxes. Okay, so the first one is property taxes in California. We've got a very unique property tax system here in California that's important to understand because the real estate appreciation here in especially coastal California has led to this system. Proposition 13 that was passed in 1978 caps the annual increase on property taxes at 2% per year. And if you lived in California in the late 70s, 80s, 90s, you know that property values are much more expensive today than they were back at that point in time. And they've gone up a lot more than a 2% increase. So there's a very favorable law that allows you to keep your property taxes to a minimum. There's a couple. Go ahead.
Marty, I'm going to interrupt you for a second. Does the Prop 13 and the step up in basis have anything to do with each other?
No.
Okay.
No, they're totally different. The step up in basis is an federal estate tax law.
Okay. Income tax law.
Income tax, estate tax, correct. Yep. You've got Proposition 58, Proposition 193. So these allow for parents or grandparents, in some cases, to transfer their property tax base, which is a low base, to their children or their grandchildren. In order for it to be from a grandparent to a grandchild, the parents have to have passed away. But it is possible to go from a parent to a child on their primary residence and retain that low property tax base. So that's a tremendous asset that I like to point out anytime we're having estate planning conversations with families. We like to point that out. That's a huge value on properties that were acquired decades ago that may have a much higher value. And if someone were to come and buy that property, they'd pay a much higher property tax every year to the county.
But if somebody wants to do this, let me caution everybody that if you want to do this, it is very technical. And so get the help of a CPA, an attorney involved prior to your death so that it's understandable and that you set it up appropriately. Because the counties don't like for you to continue your regular tax base. They want to have property taxes or major income for counties. So it's very technical in order to receive it. Go ahead, Marty.
And I would add the same for Proposition 60 and 90, which is that the last on the far right there, that you really want to make sure you're crossing your T's and dotting your I's for the reason Pete brought up. The counties want to get property tax revenue. However, you have a legal right to minimize that if you're following all the rules. Sometimes it gets a little detail oriented, and the counties will try to charge you, the new assessed value on properties instead of, the old value, that Prop 13 value that you want to pass on. But Prop 60 and Prop 90 allow for a one-time transfer of your base year property tax to a new residence for homeowners over the age of 55. The only difference between 60 and 90 is 90 allows you to do it outside of the county to some other counties within the state of California. Prop 60 is when you're just staying within your own county. Not all counties in the state allow for that transfer. There's a list online if you look for it, or you can send me an email if you're curious.
Marty,
Counties allow for that.
Marty,
Yep.
There was a question yesterday regarding Prop 60. Is that one transfer that they are allowed as a couple or one per spouse?
It's per couple.
Thank you.
Yep. So you can only do that once during your lifetime. You can't continue to do that. But it is an opportunity to downsize. Now, the value of the home needs to be equal to or less than the value, the value of the home you sold. So if you're selling a home, the idea is you're downsizing. Well, you can actually move to a house that's bigger as long as the value's lower. That's the key. As long as the dollar value is lower, you can do that. Okay, so that's property taxes that, we spot some different planning opportunities there for clients, and it's something to be aware of because there's big dollars and big potential savings on the line. Okay, moving on to federal gift and estate taxes. The good news is this tax does not apply. The estate tax exemption, as you can see here in shaded in blue, will not apply to the majority of American taxpayers, right? Most of us don't have $11.58 million to pass on to our heirs. And that's per person, right, per spouse. So if you're a married couple, you can double that. You're looking at over $23 million you can pass on to your heirs under the current tax system, estate tax free. So there's no tax cost to that. oftentimes we will recommend that parents continue to keep assets in their estate until they cross over that threshold, because any assets that they have will receive a step up in basis upon their passing, which is going to be a favorable way to inherit assets for heirs.
If I don't happen to have, if I don't have children, can I pass that to my niece or nephew, bloodline? Or can it only be my child or grandchild?
It can go to any heir. Yeah, this exemption is associated with the estate, not the person inheriting money.
But if I'm passing property, will it be able to pass at the step-up basis, but hold the value for property tax that it would have if I had a child? And yesterday,
I'm sorry, Don,
we
I
had
don't know
an.
the answer to the question.
Okay, so I'll just read it to you. What if I don't have children? Can I pass property to niece and nephews? You could pass
Yes,
it to
you can.
anybody.
Yes, you can. However, if the question's asking about the previous slide, right, to be able to retain a low property tax rate, we're talking about real property, or your residence, Prop 58 and 193, they're not going to apply to a niece and nephew.
Okay,
Okay,
thank you.
So that benefit will not pass on. However, this federal estate, this is the federal estate and gift tax law, that will allow you to pass the assets on tax-free, estate tax-free, to your niece and nephew. Now, anytime we talk about estate taxes, I think it's important to understand gift taxes. The main difference is going to be estate taxes are assessed at death. Gift taxes are during life, okay? And you only have to pay gift taxes if you give away more than this $11.58 million, okay? But you do have to file a gift tax return anytime you give away more than $15,000 to another individual, okay? And so that any one person can give $15,000 to another person or less and not have to file a gift tax return. You cross over that threshold, you have to file a return, but there's no tax due. It's just a compliance requirement. And the IRS wants to start chipping away at this 11.58 exemption amount that you're allowed to give away at death. So the annual gift tax exclusion, again, is per person, per spouse. So a married couple, you can double that number, okay? Any questions on the federal gift and estate before I move on to income taxes?
There was one question in terms of when does this tax provision expire? And since we didn't talk about income tax, the inheritance tax, I believe, expires in 2025?
That's correct, yeah.
Or if a new Congress changes it.
Correct, yep. So, you know, the Congress can change their mind at any point in time, right? But if nothing's done, no action is done, this high exemption amount will actually become much lower after 2025, when the current tax laws are scheduled to sunset, right? And so back in 2018 through 2025 is when the tax laws that President Trump got pushed in apply, and then we have what's called a sunset, where we revert back to the 2017 tax regime in 2026. You know, so it remains to be seen whether or not we'll make it through that full stretch of 2025, and the election here in November will tell us a lot.
And there's a question on the $15,000. The $15,000 is per person. So I could give $15,000 to anybody I want, and my wife can give $15,000 to anybody she wants, and we don't have to report any of that to the IRS.
That's correct.
Because it's per person, per person.
Correct. And I would add, because this comes up frequently, if you're giving assets to a married person, right, and you're married, you can pretty quickly get to $60,000, right, by giving, you know, a husband can give $15,000 to, you know, each partner of a married couple, and then a wife can give $15,000 to each partner of a married couple. So 15,000 times 4, we get to $60,000. If everybody's married, it's a little bit easier to do that.
And the question then had come up on how can I save money on the 40% estate tax? And the answer is stay under 23 million if you're married today.
Correct. Yeah, you can spend your money. You can give it away to charity. That's a great way to do it. there's all sorts of other creative methodologies that enable you to keep money. So I would say that that's definitely something to talk to an attorney, a financial advisor about, and seek professional advice. The cost for that professional advice will be far more offset by the value of not paying taxes. It's very easy for professionals to give advice and reduce that tax with some proper planning techniques if you're over the $23 million. Okay, great questions. Thank you. So moving on to income taxes, and this is really going to be the rest of the slides that I wanted to focus on today. So we're going to look at a few areas. We'll talk about income first, then deductions. We'll talk about some other taxes to be aware of, and then I want to get into some of the 2020 coronavirus-related rules. So I always say that, you know, income taxes, talking about income taxes alone is boring, but it's fun to understand and start to think about what we can do to save income taxes. For most of us, income taxes are going to be the highest cost, the highest expense we'll pay throughout our lifetimes. So the more we can do to chip away at that, the more we can enjoy the money that we have and put it towards causes that we care about. Okay, so one of the things that frequently comes up is ordinary income versus capital gains, right? So this is a federal income tax. You've got two different types of taxes here. Ordinary income, on the top here, you can see the tax rates that apply to ordinary income. They start at 10%. They run all the way up to 37%. Okay, and you've got different thresholds depending on if you're single or married filing joint. There's other filings as well that I haven't put on here, but these are the two most common filing statuses we see that I've included on here. Capital gains tax rates, there's only 3 that apply, and as you can see, they're much lower. So capital gains tax rates are more favorable than ordinary income tax rates because they're a lower rate. Now, let's talk about the type of income that's assessed on those. So ordinary income is going to capture most of the ways we make money: wages, interest and non-qualified dividends, Social Security, pension, distributions from IRAs, rental income. Okay, and if we buy an investment and we've owned that investment for less than a year and we've made money on it, that's going to be taxed. Any gain on that investment is going to be taxed as ordinary income. That's these rates here on the top to the right-hand side, right? The 10% up through the 37%. Now, capital gain, the more favorable, lower tax rate, applies to far fewer items: qualified dividends or gain on the sale of an asset owned for greater than 1 year. Okay, so sometimes when we have investments, we want to try to wait at least a year before selling those if we've made a gain on them, because we can save money on income taxes. Any questions on this slide? Or the difference between ordinary income, capital gains?
Yes. Do you add the ordinary income to capital gain income to determine the rate for capital gain, or is it calculated separately?
That's a great question, thank you, because I skipped over that. Yes, you add the ordinary income to capital gain to calculate the rate at which it will apply. And that's where you get this taxable income number here at the top on the right-hand side. So that taxable income number that's going to determine which of these brackets you fall into for both capital gains and ordinary income. Okay? So this is a great, if there's one thing to understand about your personal tax situation, you know, it's to try to understand what tax rate or bracket you fall in.
Marty?
Get out your, yes, Pete.
If somebody had $50,000 in ordinary income and $40,000 in capital gain income, so where on the chart would my tax bracket be?
Yeah. So here's $50,000 of ordinary income plus $40,000 capital gain income is $90,000, right, Pete? And so
Right.
I'm going to skip ahead because what we have to do to get to that taxable income number on the top here is subtract our deductions. And I'll get into deductions more in a minute, but let's just assume this person's single, okay, and they've got a $12,400 standard deduction. Okay, so we're going to take that $50,000 plus the $40,000, we have $90,000. We're going to back off the $12,400 standard deduction. So what does that give us? My calculator is going to give me $77,600 of taxable income. Okay, so they're going to fall in the 22% bracket here. So not all their income will be taxed at 22% because they had some capital gain income, but they're going to ride up. So their first $98.75 is going to be taxed at 10%. Then they're going to move up to the 12% bracket. So it's a gradual buildup. So most of that income will actually be taxed below 22%. And then with respect to capital gains, because their taxable income is over the $40,000 threshold, they're going to pay a 15% federal capital gains rate on that. Okay, so
do I get to deduct my short-term capital gains?
In the calculation there?
Sure.
Repeat the question, Don.
Do I get to deduct my short-term losses from my capital gains?
Yes, capital losses offset capital gains. You can only use, as a married couple, $3,000 per year of capital losses to offset ordinary income. If your capital losses are more than $3,000, those will carry forward to be used in future years.
But if you have more capital gains, in other words, let's say you have a capital gain of 10,000 and you have a capital loss of 10,000, can you use all 10,000 of the loss in that year?
Yes, you can, Pete.
Okay.
Great question.
One of the things that comes out really clearly in this discussion is that you need a good professional in the year of the taxable income. So right now, between now and the end of the year, you should be doing some tax planning, not wait until next year when you go do your taxes, because then it's too late to do anything.
Yeah.
More question before you go on, Marty. Can I ask another one?
Please do.
Okay. Just to confirm, the tax rates on your chart are for ordinary income and capital gains, are the same for all age groups except for the extra $1,650 for over 65 and blind for additional deductions. Tax rates are tax rates, regardless of age. Yes?
That's correct. These rates apply to everyone, regardless of age.
Thank you.
Okay, let's go to the next slide, Marty.
Okay. Deductions. So this is where we want to try to find expenses we've incurred throughout the year to reduce the amount of our income that we're going to be taxed on. Okay, and the first way we do that is we try to look at how much our itemized deductions are on Schedule A of a tax return. So it's going to be your medical and dental expenses over 7.5% of your income. Okay, so you can only deduct those to the extent you have the expenses that are over 7.5% of income.
Just to remind individuals that if you have a caregiver, we always deduct that under medical expenses. Go ahead, Marty.
Taxes that you paid. So this is, unfortunately, right now under the current tax laws, limited to $10,000 deduction per year. Okay, it used to be unlimited. Now, taxes that you have paid to the state, property taxes would fall under here on your personal residence. If you live somewhere where there's a local tax, which doesn't apply here in California, but other states tend to have some local taxes, those are eligible to be deducted here to offset your federal income. But here again, it's limited to $10,000. Okay. Interest you pay. The most common deduction we see here is interest paid on a mortgage. Okay. Interest you paid for personal expenses on credit cards, those typically are not going to be deductible. It's primarily a mortgage interest or an investment interest deduction that we see here. Gifts to charity are eligible for a deduction, subject to some limitations. It's rare that people come across those limitations unless they're making a substantial gift relative to their income. Okay, if you're giving away less than half of your income during the year, you're not going to run into those limitations, assuming it's a cash gift. But again, if you want to make a gift that's not a cash gift to a charity, it's good to seek out the help of a professional.
Marty, if I'm doing work for the Red Cross, can I deduct my time?
No, you cannot deduct your time. You can deduct your mileage. So the IRS has a rate for it. So I would assume, if you're driving in the car and driving home, that mileage has a assessed rate that changes every year that you can take as a tax deduction, but your time is not deductible.
Am I allowed to also deduct it if I'm going to my doctor's visits, my mileage?
Yes.
What's
yes,
the rate,
mileage,
do you know?
It's between 10 and 20 cents per mile. I'd have to check. It changes every year. It's probably closer to 20 cents per mile.
Thank you.
Yeah, but that's on the IRS website if you want to see that. Okay, so when we uncover our itemized deductions, we're going to add all those up. Okay, and we want to see, is that number higher or lower than the standard deduction here at the top of the screen? Okay, and the standard deduction varies whether you're single, married, filing joint. If you're over age 65 or blind, you get an additional add-on to that standard deduction. So you want to take the greater of the two, okay? Now, these standard deductions were increased with the new tax laws that were passed starting in 2018. So a lot of people that were itemizing deductions prior to 2018 were now taking the standard deduction, which in a lot of ways simplifies your tax return, right? You don't have to worry about tracking all these expenses anymore if you know you're not even close to the standard deduction. But this is a good exercise to go through, and typically the tax preparer that you've engaged, or if you're doing your taxes yourself, the tax software will take you through this to compare those two numbers. Okay, again, the deductions are what's used to reduce your income to get to that taxable income number that we see here. And that taxable income number is what determines the tax rates that apply. Okay. Two other taxes I wanted to point out. These are big, so it's important to understand. We've got the net investment income tax, okay, and this was the Obamacare tax of 3.8%. It's a federal tax. It's tacked on to your net investment income, okay? So think about dividends, interest income, capital gains from the sale of any investments on income over $250,000 for a married couple. If your income's below that, this 3.8% does not apply to you. Okay, but if you cross over that $250,000 threshold, you're paying an additional 3.8%. So that's in addition to the capital gains tax that we saw on the earlier slide. And then here in California, I didn't put the brackets up, but pretty quickly in California, most taxpayers are going to get into the 9.3% tax bracket. Okay, you start at 1%. Once you cross over $1 million, you're going to be 12.3 or 13.3%. Most of us are going to fall in the 9.3%, which is a high tax rate as far as states go. We're one of the highest tax rate states in the country. So that's also important to take into account. One thing that is coming up right now, some tax planning we're doing around that, is because there is potential for a new president to be in charge next year, right, in 2021, if the current tax laws went away and that state income tax deduction was no longer limited to just $10,000 as an itemized deduction, clients may be better off paying any taxes owed to California next year. We don't know. It's too soon to tell. We'll probably have a little bit better idea after the election, but that's something we're talking about with clients, is potentially waiting to pay California until next year, because you could potentially receive a deduction on your 2021 federal income tax return that you would not be entitled to receive for 2020.
Marty, there's a question back in terms of AGI. Isn't there a general over 10% AGI restriction for medical and dental expense, and with over 7.5% of AGI requirement based on certain ages, or was that done away with?
Based on, okay, so it's been 10% or 7.5% as a portion of AGI at different points in time. I don't think the ages have mattered. I think it's really for anybody. It just tends to be the, you know, older people that are taking advantage of the deduction because they tend to have more medical needs.
And incidentally, before I get the question, AGI is adjusted gross income, which basically is the sum of all of your income before you start taking deductions.
That's correct.
Thank you.
By the way, everybody believes that they're paying too much in taxes. The only good thing about paying a lot in taxes, that means that you've made more money.
And the good question just came in. Do you recommend clients move to Nevada for they have more flexibility for their primary residence?
Well, yeah, the Nevada state income tax is zero, right? So there's a non-financial component to that decision, certainly. You know, the beaches in Nevada are typically not as nice. I've been to Lake Tahoe. They have a nice beach there, but you know, the beaches there typically aren't as nice as they are here in Southern California. So, you know, you've got a non-financial component to that decision that only you can understand. What we as advisors try to help them understand is the financial side of it. And there's absolutely financial savings, you know, on the state income tax side if you're willing to live in Nevada for over half the year. What I wouldn't recommend is lying and saying you live in Nevada for half the year when in fact you do not do that, because the franchise tax board here in California is very aggressive with their audits. And if you're not doing that, you're taking a big risk.
Yeah. And there's another kind of a old motto, don't let the tax tail wag the investment dog. What does that mean, Marty?
Yeah. Well, taxes are an important factor in any decision, but they certainly are not the only factor. And so you don't want to make decisions based on taxes alone. There's a lot of other factors that need to be considered. So there again, if you're thinking about moving out of state, right, you've got a lot of non-financial considerations there.
Question for you, Marty. My husband passed away in February. Do I have to file as an individual or as a married person filing jointly?
You would file you could be married filing joint for this year.
For how long?
Just for this year. Then you can look at head of household to see if that's a filing status you can use in future years. But you would not be single for this year. You'd be married filing joint this year.
Thank you.
Okay, so one of the things that in the estate planning area that we ought to be thinking about is that the step up in basis. We should have, for all of our assets, we should have the property listed. We should have how it's titled, and we should have its cost basis, and we should have its market value.
So what is step up basis in that?
Marty, go ahead.
Yeah, it's a good point, Pete. And the step up in basis is an overlap between estate tax laws and income tax laws. Okay? And when someone passes away, the basis in their assets is stepped up to the market value. It could be stepped down as well, but typically we see a step up in basis during times like this where we've seen more appreciation than depreciation in assets over the last decade.
Let me give you an example, Marty. I bought a stock for $100 and it's now worth, it's going to be Apple stock and it's now worth $5,100. If I were to sell that stock today, how much taxable income would I have?
Yeah, on that alone, you would have a $5,000 capital gain that you would have to pay taxes on. You paid $100, it's worth $5,100. You pay taxes on the difference.
If I gave that stock to my son during my lifetime and my son sold that stock, how much taxes would my son have to pay?
the same. The amount of the capital gain would still be $5,000.
And what if I waited to give that Apple stock upon my death to my son, and then my son sells it?
That's where you see the step up in basis come into play. Now, your son selling an asset worth $5,100, the basis is $5,100. Your son pays zero. There's zero capital gain, zero income taxes on that.
Okay. Step up in basis is really an important rule that you should consider before you sell an asset later on in life.
And Marty, if I own multiple homes, what percent, and I'm only retired, so I have no income in any specific state. How much time do I have to spend in a state to claim residence there?
Over half the year you need to spend in the state of residency.
Thank you.
Okay, so
Anything else, Marty?
yeah, I've got a couple more slides, Pete, on the Secure Act and Special Coronavirus Act. So, but shouldn't take more than a few minutes here. We're doing okay on time?
Yes.
Okay. So, in 2019, the Secure Act was passed, and it was primarily driven towards retirement accounts and retirement planning. Okay, so I just want to touch, there was a lot of legislation there. I want to touch on a few of the key things that happened. It's probably the biggest change we saw was that required minimum distributions from retirement accounts, which was previously mandated at age 70 and a half, is now age 72. So you have to take required minimum distributions, right, from your retirement account starting at age 72 now under the new legislation. Okay, the other thing that is pretty important from a planning standpoint, particularly if you have a lot of money in retirement accounts, right? If you have 7 figures in IRAs or 401ks, this comes into play because non-spouse retirement account beneficiaries now only have 10 years to withdraw money from that account. They have to pay taxes on that money when they withdraw it from the account. So their tax costs to withdrawing that are higher. Prior to this rule change, they were able to withdraw that account over their lifetimes if it was structured properly. So they could just take a little bit out every year and not have to worry so much about the taxes. Now, the IRS is saying you have to take it out, you have to empty the account out within 10 years of it being inherited. There was some other legislation to give employers more incentives for retirement plans. Congress is looking at 401ks and other employer retirement plans as a way for Americans to save more for retirement. They're acknowledging that that's not being done very well. So they want to incentivize employers to put those plans in place. I'm not going to get into those details, but that was another big piece of that legislation.
Yeah. We have a whole hour and a half on retirement plans.
Great. CARES Act. So this is a 2020 legislation that came out, and we're seeing changes happening almost monthly now because sometimes the IRS will come out with legislation and then everybody has questions as to how it's going to be enforced and how to treat different situations that maybe the legislation didn't address very clearly. But this is all from coronavirus related provisions. So you've got unemployment compensation benefits and small business assistance in the form of loans and tax credits that are coming out. For 2020, required minimum distributions were waived from retirement accounts. So that means you did not have to take a distribution from a retirement account for this tax year.
However, should somebody take not a required minimum distribution, but when should somebody take a minimum or a distribution this year in 2020? Sure.
I would say you want to look at taking one if you think it's going to be taxed at a low rate, especially a lower rate today relative to, next year or the year after. Yeah, that's why you want to know your income tax bracket so that you can say, hey, maybe I should take a distribution from my IRA this year.
And incidentally, it also is if someone needs the money.
Yes.
Yeah, if you need the money, the taxes kind of become a a secondary, like Pete said, don't let the tax tail wag the dog. If you need the money, you need the money. Pay the taxes. But this final bullet point, coronavirus-related distributions from retirement accounts. So this is really something that applies to taxpayers under the age of 59 and a half. Okay. In the past, if you withdrew money from a retirement account and you were under age 59 and a half, the IRS and the state of California are going to hit you with additional penalties on top of the normal income taxes you will pay. For 2020, the IRS in California has also conformed to this to say that they will not charge penalties on that distribution as long as it's $100,000 or lower. Okay, anything over $100,000, they will charge penalties. But below that amount, you can make withdrawals from retirement accounts. Okay. The second thing that came up is the IRS is giving you 3 years to repay that money to a retirement account. Okay, so you can take the money out here in 2020, you have until 2023 to pay it back. And the nice thing about it is you can spread that income over 3 years. So you can pull out the money in 2020 and spread that income evenly over the next 3 years, which helps to reduce the tax rates potentially. So there's a nice tax planning opportunity there for taxpayers that are under age 59 and a half that may need some money because of the pandemic. Now, you need to have been impacted by coronavirus. I've got some clients, their business is booming. They or their family members have not had coronavirus. They've not been really as adversely impacted as maybe others have by this pandemic. So they would not be eligible for these laws and to take distribution. But I've got other clients that have lost jobs and maybe the health of their family has been impacted. Maybe they've had coronavirus. They can take withdrawals that are penalty free from those accounts. And they may want to do that as a tax planning item, particularly if their income's down, if they've lost a job. Maybe they can pay a lower tax rate on taking that money out today versus in another year. Or maybe they just want to have it just in case something happens. We don't know what's going to happen with the pandemic. And so it's kind of a safety play if you want to take it, because this only applies for 2020, not something that you can do in 2021 at this point.
And our savings.
Marty, back up a slide.
Okay.
You have this thing of income tax credits against 2020 income. What does that mean?
Yeah, so there's different credits that are applied to individuals and businesses. There's a refundable income tax credit against 2020 income.
Marty,
Yep.
Explain the difference between a credit and a deduction.
Thank you, Pete. A credit is a dollar for dollar reduction in the taxes that you have to pay. Okay, and that's more favorable than a deduction. A deduction merely reduces the amount of your income that is subject to taxable to the tax rates we looked at earlier. Okay, so if you have to pick between the two, the credit is more favorable. And so the income tax credit, now you have some income limitations here. Okay, so if your AGI, your income for a married couple exceeds $150,000, for other filers like single, it's going to be $75,000. You can get it a tax credit of $2,400 for a married couple, $1,200 for an individual. Okay, and if you have children under the age of 17, you get $500 per child. Okay, so those are some of the different tax credits that come into play. They'll automatically be applied on, on your tax return when you're doing those for 2020.
Okay.
I'm sorry, I have to read this one to you, Pete. Here's the suggestion. Oh, wait, I'm sorry, it moved. Moved on me, where is it? Sell everything now. I noticed the water behind Pete hasn't moved through the whole webinar. The sky is falling. I like it. Anyway, sorry.
Okay. It's not a tsunami.
Okay, I've got, so here's my contact information. If you have questions about anything we talked about today, please don't hesitate to reach out to me. This is my email address. And the other thing, and this is something Pete touched on earlier, this is a great time of year to be doing tax planning for the year, because most of the year is behind us, right? We have a pretty good idea where our income and expenses will fall, at least now here at the end of September, that, you know, than we might have in January or February. So October is a great month for income tax planning. We send an email during the month of October on every Friday on a different tax planning topic. If you would like to receive that email, you can just send me an email, put taxes in the subject line. That's all you have to do. I'll sign you up for the email. We're not going to send you any other information. It'll just be those 5 emails every Friday in October with a different tax planning topic. So that's all I had.
Yeah, just my spouse is a CPA and she does taxes. She has approximately around 300 clients. How many individuals do you think will call her this year to do some tax planning?
Less than 30 would be my guess.
Usually maybe 1, maybe 2. Most individuals do not know how to use professionals. What do CPAs, what do they usually charge per hour? Marty?
I would say it's going to be in the $100 to $400 range, depending on the business model for that CPA.
Yeah. And so,
More than that.
so people don't sometimes don't want to pay that fee in order to get some good advice. And what I usually find is that it's very well worth the fee, especially if your income or you have a complex estate. You cannot know all of this information yourself. It's kind of like Marty is a financial advisor. He handles the investments, but he doesn't do the tax returns. So you need to do tax returns on a regular basis to really be good at it.
Yeah, and Pete, the best way to do tax planning is to take your best guess at what your tax return is going to look like here. And then ask yourself, is there anything I can do to make my situation better, right? You know, whether that means coming up with more deductions, it may mean taking more income this year, right? If we found out that Biden wins the election and he's got plans to increase tax rates, right? If we find that out here, you know, we may have time in December to say, wow, we may want to actually accelerate some income this year because we think tax rates will be higher in the future.
Yeah,
and
again, it may not be a higher tax rate for you. It may be a tax rate for somebody in a different tax bracket. So each one of us are individuals and we need to look at our own individual return. Stop listening to the media and don't act on fear.
Yeah, and I'll have clients all the time say, hey, my friend's doing this or that. Is that something I should be looking at? And I love those questions because sometimes it's, well, let's take a closer look. Other times it's absolutely not. That does not make sense for your situation, and here's why.
Okay.
So
let's go to the test. Marty, stick around. I want you to help.
No.
Oh, okay.
Marty, why don't you stop sharing?
Okay, you got it.
Okay, let's see. We only have 22 questions that I didn't ask you and that I didn't answer. So I'm just going to, these didn't fit in necessarily into categories we were at. And so some of these, feel free to say, that's going to be later.
Okay.
What type of electronic vault would you recommend for my important documents upon my demise?
No clue.
Okay. How much should I expect to pay to have my will and trust drawn up if I have a net worth of about $5 million?
Anywhere between $1,500 to $10,000.
To save money, can I use Legal Shield to do my will and trust?
Please don't.
Okay.
You have a second. Hang on a second. $5 million is a substantial estate. Don't be stupid? Or don't be...
I think it's penny smart, pound foolish, Pete.
Yeah, thank you, Marty. Yeah, we get that a lot. By the way, every single attorney that's going to be presenting, we're going to ask them what their fees are. So please keep that question in mind.
What's a fee-only firm?
Marty, what's a fee-only firm?
100% of our revenue comes from our clients. And that's important because it allows us to put our clients' interests first and foremost. It's very critical.
95% of the industry of people calling themselves financial advisors earn commissions. Stay away from a person who makes commissions. Go ahead. Next question, Don.
I'm answering one, so we don't have to do that one. So let me send that one. Okay. I'm sorry. If you sell your house and do a 1031 exchange, which is odd for private residence, can you get benefit of Prop 60 or 90 if you later decide to do rental? I don't think you could do a 1031 on a private residence unless it's rented. Then it's rental property because that's commercial only, I believe.
I don't know the answer.
Okay,
Yeah.
Next.
Marty, do you know the answer?
So to do a 1031 exchange, it's got to be an investment rental property for 2
Now.
years.
Now,
Okay.
yeah, right.
Yeah.
What's physical property?
Physical? There's real property and personal property. It's a good distinction. There's no such a thing as physical property unless you, I guess, see it physically.
So define your terms.
Real property is property that is connected to the earth, connected to the house. Personal property is your fishing reel, rod, your car, things that are not connected to the land.
Okay. Estate exemption means my children will not have to pay tax on it.
Children never pay taxes on estates. The estate does.
Okay, but if my estate is worth today, if I'm single, 11.5 million, then I will not, my children and my estate will not pay any taxes.
Correct.
Okay. I bought a house in 1987, paid 190,000 in San Diego, just sold it for 930 and bought a mobile home for 540 in Orange County. What tax do I pay on the gain? Ooh, ouch, a lot.
I think
how does Prop 13 apply to my property tax?
that's an email question.
Gotcha.
Send that email
Okay.
to Marty.
Okay, there you go. Perfect. So this one there's a combination of these, and it's interesting, so I'm trying to put them together. I'm ill. Now, a lot of people have said that about me, but this is the question. I'm ill. Should I take IRA money and give it as a gift? Can't.
You can. You can
While you're alive?
take it out. You can take it out of your own IRA and then gift it.
Well, yeah, and I would say too, this is if your medical and expenses are in excess of 10% of AGI or 7.5% of AGI, you have a tax planning opportunity there to consider, because you may be able to take money out of your IRA at a much lower tax rate than the people you would leave that to potentially.
Okay. Which one is better between Prop 60 and having the trust for the property? Does the trust also let the children keep the same property tax basis? With the trust, there's a step up in value. Does Prop 60 apply?
Trust has nothing to do whether or not you get Prop 60 or Prop 13. It goes to the individual.
But it does have a step, the trust would have a step up in basis of the property.
Correct.
Yep.
Okay.
Yeah, and Don, just to make that clear, because
Please.
the property taxes, it's a California tax that's paid to the counties, okay? The step up in basis is a federal tax, income and estate tax.
Estate, right, good point. The net income tax is up to a certain amount for single people, or is that for everybody? The 3.5%?
The 3.8%?
3.8, sorry, yes.
Yeah, it's $250,000 for a married couple. It's half that for single filers.
Do I have to file a tax return if my income is under 25,000 and it's all from Social Security? Don't think so. What's the bottom rate?
I don't think so. Because only half of your Social Security gets taxed when you get above a particular level. And I don't know what that level is.
Right.
You may want to, though, especially if there's withholding from
Exactly.
your benefits. You may want to.
Yeah, because of the earned income tax credit.
Right. Do itemized deductions still help reduce state income tax? Is there a standard deduction for the state similar to the Fed?
No, it's not similar. Marty?
Okay, so California, the starting point for California returns is federal AGI. And then you do have deductions on the state income tax return.
Yeah. So you should
Yes.
figure it out.
In some cases, we're seeing clients itemizing deductions on the state tax return while they're taking a standard deduction on the federal return.
Okay.
Can we go to the
Okay,
questions? The
Yes.
test.
Oh, okay. I'll stop.
Yes.
Incidentally, if we haven't answered these questions for you, because there's a lot more. So what we will do is email these to you because all the question answers are saved. And so Pete has agreed that he's going to email you on all the questions that are outstanding still.
And I'm going to go through the questions very quickly so that maybe we can get to the rest of the questions a little later.
Go for it.
We got about 20 minutes.
Okay, I'm going to share my screen here in a minute.
All right, here we go. Just remember also, as far as the questions are concerned, we've got 8 weeks. So this is just the first week, and we'll get your questions answered. This whole program is about getting all your issues talked about. First question, the size of your estate at death will determine how much you will pay in probate fees and estate and gift taxes. Most people focus in on the size of the estate. The answer to the question is false. The focus should be on how you have title to your assets. In other words, whether or not you go through probate is determined by title, not by size of your estate. It's a little tricky question, but I want you to focus in the estate planning area on how you hold title to assets. It becomes really, really important. 2, in California, it is always wise to have a living trust. And the answer to that is that little key word in there, always. It's not always wise. Most of the time, 90% of the time, it's wise to have a living trust. But in California, sometimes you want to go through the probate process. So the answer to number 2 is false. And we'll talk about more about that in the living trust session. And we'll talk about title next week when we talk about basic estate planning. Number 3, statutory probate fees are not negotiable. False. Statutory probate fees are negotiable, and the statutory probate fees that are stated is the maximum amount of fees an attorney and a fiduciary can charge. Now, there is additional charges that can occur as well. But let's say, for instance, you've got a $5 million home in Laguna Beach and a bank account, and those are your only 2 assets, and you're going to go through probate. I certainly would negotiate with the attorney and the fiduciary regarding those fees. Number 4, for a married couple, probably the best method to hold title to property in California is in joint tenancy with right of survivorship. The answer to that is false, and it has to do with the step up in basis. A joint tenant technically will not receive the step up in basis on the death of the first tenant. So either have it in a living trust, or if you're a married couple and don't have a living trust, have it as title as community property with right of survivorship. Community property with right of survivorship. When the first person dies, the second person who receives the property receives that step up in basis for the full value of that property. Number 5, and we'll talk more about that in next week's session. Reviewing your living trust is only necessary when you want to change your disposition of assets. This is false. As soon as you sign that living trust becomes active and valid. And Marty talked a little bit about, you know, that we're going to maybe have some new tax laws if Biden wins the presidency versus Trump. Who knows? We just don't know. But Congress sets the rules. And so your trust, besides being a living, I mean, it's an actual living trust, and it can change during your lifetime. So a living trust is more expensive because you have to care and feed it throughout your lifetime. Number 6, about 1% of United States citizens or residents that die in 2019 were subject to estate and gift taxes. The answer to this is false. Now, we live here in Orange County, California, and we have a kind of a warped view of the world here. A house here in California, in Orange County, a 2-bedroom with no garage, would probably list for $500,000. If you go to Kansas, and for that same $500,000, you'll probably be able to purchase 10 acres, horses, 5 bedrooms, and you'd have yourself a very nice piece of property. So in the United States, less than 1/10 of 1% is subject to estate and gift taxes. So very few people in the United States have estates that are 11 million and up. So, and in fact, the IRS in the estate and gift area used to have close to 300 examiners. Today, they have less than 60. And every estate and gift tax return is now audited because there are so few of them. Okay? So less than 1/10. If somebody says we need to do away with the estate and gift taxes, well, that applies to maybe less than a very small percentage of people in the United States. Number 7, in order to be fair and equitable, it's considered wise to name your children as co-trustees and co-executors. For most instances, I would say this is false, unless you have a very unique family where your children get along great with one another and will cooperate. Maybe you want to name them as co, but families is where the problem is. It's not about taxes. Your estate plan today should revolve around the needs of your family. Do you have somebody who's on drugs? Do you have somebody who's mentally ill? Do you have a spendthrift? Do you have a unique situation where money needs to be managed for a period of time? So number 7 is false. Number 8, if the concern is creditors or an individual taking control of your estate, it is best to have a living trust. And the answer to that is false. I'm a fiduciary and I'm a trustee for some individuals. As a trustee, I have total control over the management of those funds. So if I wanted to, as a trustee, I can determine where people live. I can determine whether or not they need a caregiver. It is an immense amount of power that you're giving to another individual when they are named as a trustee. Creditors, at the same time, have the shortest period of time to collect under the probate system. Now,
Pete,
yes,
so what should you do? Have it be go to probate?
if you have a concern with creditors, yes.
Okay.
Or if you have a living trust, go through the probate process so that you shorten that creditor's period.
Okay. And a lot of these things we're talking about through the whole thing. So number 9.
By the way, we're going to talk about more about creditors and in the next week's session, and also in the living trust session.
Right.
Number 9, you can get a current charitable income tax deduction, and the charity does not receive the money until sometime in the future. And the answer to that is true. So, and we're going to spend an entire
I'll
session.
I'll talk a lot about that one because
Yeah.
I do that module.
Yes, you do. And
10.
so we'll get lots more information. But remember that financial professionals, CPAs, attorneys, brokers know very little about the charitable area, about the charitable gift annuity, about a charitable remainder trust. So hopefully we'll give you some good cocktail information and that you could spread to others. Number 10, the Advanced Healthcare Directive must be drafted by an attorney. And the answer to that is false. But it goes much deeper than that. Most individuals spend 10 minutes or less naming their agent for their advanced health care. And with the coronavirus, I mean, how long do you want to be on a ventilator? You know, there's some really important issues here. Now, we're going to get into some of those in the third session on this one, but we have an entire session in the It's Your Money session called Medical Care Planning. We're going to talk a lot more about that. Number 11, most people after the age of 65 will need a nursing home care. And the answer to that is true. But the real question should be, most people after the age of 65 will need nursing home care for 3 months or less. In other words, if I go into the hospital, which I have done for a meniscus, for my knee, I don't stay in the hospital very long. I go to a nursing home, a care, a rehab facility. And so most people after the age of 65 will need nursing home care for 3 months or less. If you're 85, most people will need nursing home care for 3 years or less. This has a lot to do with long-term care, how much you got to keep it liquid, how much worry should you have about needing long-term care. 12, commercial annuities are usually good investments for older adults. Absolutely false. And we're going to talk about that in the It's Your Money session next week.
But I'm also going to talk about it as a charitable annuity, maybe a very good investment, and that's what we'll talk about when I do mine.
And
13.
Completely different. They now have some commercial annuities that are very low commission or no commission, but most of the commercial annuities that are out there today are high in the commission category. 13, when a parent's resident is transferred to a parent's child, the child automatically will avoid a property tax reassessment under Prop 13. And the answer to that is false. It does not happen automatically. You've got to fill out the proper paperwork, and it has to be done correctly. please see an attorney or a CPA in order to make sure you take advantage of the Prop 13. It has to be done a certain way, and the money has to be in the estate. And what I mean by that, let's say your house is $1 million and you have $1.5 million estate and you have 3 children. That child that you're going to give the house to, if you want one child to receive the house, will not be able to get the full reassessment under Prop 13. Okay? Just remember, make sure you follow through on that. Number 14, you can get money back when contributing money to charities. And the answer is true. And Don and David Moore from Chapman are going to spend a whole session on that.
Incidentally, on question 13, on the automatic transfer, when my parents' home transferred to me, the county raised the taxes 8 times what it had been because of how long ago my parents owned the house. So we took over their bases, but that's what they were. Marty, if you want to go ahead and stop sharing this.
Marty, could you bring up the one article about mom and dad, the 1995 article?
And Marty, while you're looking for that, I'm going to tee up a question just for the absolute delight expression on Pete's face. What do you think of Susie Orman?
Wonderful entertainer, but please do not listen to her for legal and financial advice. She has no clue about your particular situation. She's an entertainer, and a really nice entertainer. And some of the things she says make sense, but whether or not they apply to you, get a fee-only fiduciary advisor. And we'll talk more about that next week in the It's Your Money session. I wanted to read that paragraph to you, the second paragraph. And this is from 1995, and it's still so true today. We agreed that we should talk to our folks about their wishes concerning things like nursing homes, life support machines, funeral arrangements. We also agreed that we should push them to get some critical legal documents drawn up, living wills, durable powers of attorney. In fact, we agreed on a lot of things. Everything that is, except who's going to pick up the phone and have the big discussion. We still haven't agreed on that one. What I'm encouraging you to do is for you, I used to think it was the kids that had the problem. I don't believe that anymore. I mean, I used to think that the parents had the problem. I don't believe that anymore. I think the kids have the problem of bringing this up. So you bring it up and let your kids know that you have your estate plan in order, that you know and have spoken to your agent for your health care. And in the event that you have the virus, you know that what they're supposed to do. And that is, you are in control. From my point of view, estate planning at death is a piece of cake because everybody wants your money and it's going to settle. But if something happens to you during your lifetime, then you need your estate planning documents and you need people that you have picked out and trust to carry out your wishes. If we got time for any more questions, let's do it, Don. Hello, Don. Uh-oh.
Sorry.
Okay.
I turned it off. I forgot to turn it back on. No, I think we're fine where we are. I want to thank everybody. I want to thank Marty. Thank you, Pete. I think all of this went great. There will be a video of this, as there was. The money was already posted on the website from yesterday, so we were good at following up quickly. We will go through, Pete and Marty and I will go through these questions that you've asked and follow up with them during the time of the next 7 weeks, or we will send you an email and suggest it, because there's some very specific individual questions that were asked that I don't think we should do in public. So I want to thank everybody for being here. Marty, Pete, thank you. Thank you, group, in terms of what all we're doing. And we will see you next week. Thank you.
Thank you, Marty. Thank you, Don.